Good morning and a very warm welcome indeed to today's Movers and Shakers virtual event. My name is Natasha Salter and I'm Managing Director for Movers and Shakers. So I hope you're all having a really great week and you're enjoying the sunshine. And we've got quite a lot of newcomers registered for today's event. So welcome to all of you. And for your benefit, Movers and Shakers is the leading UK property networking forum. We celebrate our 25th anniversary this year. We've always been a membership organisation, and the aim is to bring together the lead decision makers in organisations, organisations that can deliver reciprocal business, putting you guys together so you can do business and win work. And also, we're obviously very well known for our physical events. So welcome to you all this morning. And we do want to say, if you've missed any of our virtual events, and we're really enjoying this virtual events program, you can catch up on them on our YouTube channel. So please do enjoy and please subscribe. So to this morning. This morning is one of our Build to Rent webinars. It's number 2 in our series of 3. And we're very passionate about Build to Rent Movers and Shakers. We hold our annual one-day conference each year in February on Build to Rent London. And actually next February, it's going to be our 7th annual event. So we are really interested and passionate on the subject matter. Today's webinar is on investing in Build to Rent, performance, resilience, prospects. And we welcome an absolutely stellar panel. So welcome this morning to Andrew Saunderson, who is Director for Investments at Grainger PLC. Rebecca Taylor, who is Managing Director for Build to Rent at Harbour. Katie Rogers, who is Financial Director at Telford Homes. And Johnny Caddock is being replaced this morning by his partner Tony Brooks, who is Managing Director of Moda Living. Welcome. And our guest chair is Simon Scott, who is Lead Director of Living Capital Markets at Jones Lang LaSalle. Welcome to you all. Now, investing in Build to Rent has really gained momentum over the last couple of years as stocks being developed, as buildings are opening, and as the results are really coming in. So today we're going to look at what's been happening over lockdown. How has this asset class fared? Comparing US, UK data, how does it compare to other assets like retail, like commercial? Is it now a prospect for long-term investment, and who's investing and on what criteria? And perhaps have risks softened as the market's matured? And I think, well, I know that Simon this morning is going to be asking these questions and an awful lot more. But please remember, as an audience, you can ask questions. We have a Q&A tab on the bottom of your screen. Do ask questions. And I know Simon will do his very best to weave as many as he can into the discussion this morning. So thank you all for joining us. Thank you to our contributors. It is an hour session this morning. So do grab a cup of coffee and do enjoy. Thank you. Bye-bye.
Thanks, Lee. Good morning, everyone. I guess really where to start, and I think one of the key things that we're hearing in the market is just around resilience in terms of income. So I guess to kick off, Andrew, obviously with such a substantial portfolio within the private rented sector, just really what you're encountering on the ground and whether indeed that is indeed the case.
Yeah, thank you, Simon, and good morning, everybody. It's absolutely what we've been encountering. We've previously said that our rent collection numbers have been broadly in line with historic averages. And I think we said in April, our rent collection numbers were about 94%. I think in May, we saw a slight improvement on that. So it's very much a case of we're very pleased with our rent collection over what's been, has been a very difficult period and during the height of the lockdown.
And Rebecca, same with way of life and your portfolio?
Yeah, so we've got a slightly smaller portfolio, it's fair to say, but we've got about 1,000 units under management at the moment. We saw a slight dip in March and April, sort of towards the end of March and April, but similar to Grainger, recovered on that. So we're running about a 96% collection rate. We've got about 10% of the portfolio who pays in advance. So last month in May, we collected 86%. So again, in line with historic averages. We've had a decrease in kind of requests for COVID cases. I think there's no doubt that the furloughing scheme is helping the sector at the moment, and we're all looking to see what will happen after the summer in relation to that. But yes, still very strong performance. I think the overall impact on the portfolio that we're forecasting at the moment is just over 2% on gross rent rolls. So quite still a resilient income stream, and we're quite pleased with the performance so far.
Yeah, so you've both perfectly captured the range that we've seen with our stateside colleagues who, along with ourselves, have been sort of tracking over one I think it's over a million data points across the states and the UK, and there's that spread of sort of late 80s, mid 90s has very much been what we've been picking up as well across quite a differing portfolio.
Yeah,
and
I think we've been surprised to see new lets come through as well. So we've done about 20% of our portfolio. We've done 10% of new lets and another 10% of kind of renewals, and we're seeing growth in those renewals as well. So again, still quite robust, and but remains to be seen what happens after furlough.
And Tony, you've been reading recently. You've now completed the tower, which I think is sitting behind you, if I'm not much mistaken. Yeah. And obviously reaching PC during this period obviously must have created challenges. Can you just talk through some of the successes you've been having during this period as well?
Well, I think first of all on the lettings, the rent collection, like the other guys, we're at 98%, which is sort of slightly surprising. We're very, very pleased with it. A couple at the start of the lockdown, international tenants left because they wanted to go back to their home countries, but we also replaced them with new lettings, so that was great. Yeah, we've had a few challenges on the construction side, obviously, to try and finish off the tower. Very fortunately for us, we were nearly there actually, and really we've been doing the sort of final tidy up works. So we were able to impose a social distancing along with our contractors, Caddick Construction, on the site. That worked. It's enabled. We did experience a few small delays, but we've recovered that, and we've been able to finish the tower now. And we launched the tower on our digital platforms yesterday, and I'm pleased to say we've got 80 viewings booked already over the next 2 weeks, which is absolutely fantastic.
Amazing. And also been hearing you're sort of innovating a sort of matching up, a sort of co-living buddy style approach to some of your shared units.
We have, yeah, which is very interesting, especially in this environment, because personally I thought that would be really challenging to get two unknown individuals to team up together and share a flat. So we tested it out, and actually straight away we got 2 people that had never met agreed to share an apartment. We've now got 2 or 3 more of those underway. We formed a Facebook page so that people can effectively engage themselves with other people on hobbies and likes and dislikes. That started to get some traction, and actually getting our 2-bed sharers in that market is a really positive thing. So it effectively basically broadens your market by 2, really. Yeah. Actually, it's working really well. So it's a new thing for us. I think it will be very successful. We're really pleased with how it's going.
So there's some great news on the letting side, and we've had a first question in just in terms of occupancy levels being retained. So again, Andrew, perhaps just from a Grainger perspective, obviously proving quite resilient.
Yeah, absolutely. We saw a bit of a drop, broadly in line with what Tony said, actually, where we had some, we do have a small number of students within our portfolio, some of whom wanted to go home, be they UK residents or international residents. But actually what we've been surprised and very pleased with is how, particularly post the easing of the lockdown restrictions on the 13th of May, how the market has come back quite strongly. And I think it's probably fair to say now that inquiry levels and leasing levels are broadly where they were pre-lockdown, actually. So that is a really pleasing sign. So yeah, a bit of a dip at the beginning, but I think we're now back to where we would expect to be, and we are now leasing at broadly the rate we would want to be leasing at.
And Rebecca, same from your perspective?
Echoing again what Andrew said, I mean, we've got our London portfolio has actually been quite resilient. We hit nearing 100% occupancy just before the lockdown, and we haven't seen too much movement in those. There's less students in those assets. Our regional assets have been a little bit varied because they've seen more student. And actually, in one of the assets where we were testing out serviced apartments, that's probably been the biggest impact. Although it only applied to a very small number of units within that block. So yeah, I mean, broadly stable. I think coming back again, the lettings market. We are coming into what's typically our busiest period, and we're not seeing a slowdown in that yet. So. Even those international people who went home, we saw, wanting to retain their kind of options and discussing when they're coming back as well. So we've approached each case on a case by case basis and looked at being flexible for those customers that have been with us.
So that resilience is really there. The other thing that I sort of picked up in the market is just discussion as a sort of multifamily build to rent, more highly amenitized product, which Tony with Moda is very much front and center. How have you, obviously with some of the features not being accessible, how's that, how understanding of your occupier base been to that? And I know you've done some interesting things, socially distanced Pilates and things like that. Do you want to just sort of outline some of the bits and pieces you've been up to?
I mean, it has definitely been challenging. There's no doubt about it. If you move into a Moda building, you've normally got the gym, the communal space, the cinema room, the business lounge, all of those things at your disposal, and obviously we had to close them. So there's a lot of resident expectation management going on. But part of our offer and our app, actually, we invested heavily in our app right at the beginning, and that really came to the forefront during the lockdown because we had 30,000 resident engagements on the app during March to May. And that was everything from, we put on bread deliveries, we put on beer tasting, we put on pasta cooking, where we would drop a pasta pack off at the door and then get a local celebrity chef to do a Zoom cooking show. So all of the resident engagement on the app has been the way that we've combated the difficulties of having the amenities closed down. And now they're opening up, of course, so that's great, but it's also meant that people have been able to use the app and got much more familiar with it. And actually, it's the tech platform that has really, really been very important and come to the fore during these challenging times.
Yeah, I'd second that with Tony. I mean, I think we always talked about community and build to rent and what we were striving to achieve. I think pre-COVID, I think COVID has meant that it's challenged us all in trying to bring that innovation further up the curve. But I mean, we've been really focusing on vulnerable people as well. So we've been dropping off mind packages and opening up the community forums for that. We again have had similar to Tony in terms of cooking demonstrations. They happen every Wednesday. And through Instagram, which is getting great engagement, and also fitness clubs. So devising running routes for people and people kind of getting on Strava. I know you're on that, Simon, for your cycling. But I think it's been really good to kind of actually demonstrate that the proof is in the pudding with regards to build to rent. That it's not just stuff that we're talking about, and also that amenity isn't necessarily rooms, it's also the community engagement and those people on site. So I think it's been invaluable for the sector, not just us involved in it.
Yeah, that's the thing, really sensed. So I think obviously accepting that there may be further challenges in terms of occupancy and rental performance going forward off the back of furlough starting to come to an end. I think the resilience relative to perhaps other commercial sectors out there is really resonating with a lot of the capital. It seems to me that it's multifamily and logistics that are really going to kick back strongest off the back of it. But obviously, as a sector in the UK, what we struggle to match with our stateside and dare I say German colleagues with a more institutionally acceptable or accessible investment market is actually the stock, which is I think probably a great time to bring Katie in from Telford. I mean, you've made massive changes over the last few months in terms of direction of travel, really focusing on delivering and obviously the partnership with or relationship with Trammels. For the audience, would you mind just giving us a bit of a view as to how you're seeing the market and how that relationship is evolving?
Yeah, so for those who don't know, Telford Homes were acquired by CBRE in October of last year, but more specifically it was Trammell Crow Company, which is their US subsidiary that focuses on build to rent, or as they like to call it, multifamily, and logistics for that matter, and some commercial and retail. But Trammell Crow, we're looking to expand out of the US. and they were looking at various different areas, not just the UK, but across Europe, and focused in on London, and specifically then started looking at how the deals work in the UK versus the US, and we're quite surprised actually that how the forward fund market works, because in the US obviously it's much more established, and it's more trading assets when they're stabilised. So they were quite surprised that you could get funding throughout from investors. And the reason for that really is because we don't have the stock yet in the UK to trade. We're getting there, but we don't have it yet. So Trammell Crow then focus their attention a little bit closer to developers, because they can then buy into that forward fund mechanism and develop as well. So they acquired us back in October, and really have given us unrelented support since then, even through this difficult time, in that they want us to grow as a business. They see the fundamentals of the market being strong in the long term, and they're focusing on the long term. So we were already moving from being a typical for sale developer into build to rent anyway, with our first deal in, I think it's 2016 now. But this has really accelerated that. So we are still looking at forward fund deals, but also we are considering the US model as well, in terms of co-invest type model, where we will potentially hold the asset with an investor with debt, and stabilise the asset and then sell it at that point. So I think the market is continuing to change, and some of that will be driven from the US in terms of their funding models and that sort of thing. But the demand is still there. The investor appetite is still there as well. So really we've ploughed on during this time buying land, because as I say, we're looking at it as a long-term asset class, as some people have mentioned already.
Yeah, so continuing to be active in the land market, backing it off with that sort of support. Tony, obviously with Moda and your relationship with Apache, been on the fundraising path quite a lot. I guess what are the sort of key takeaways from the conversations you've had, and I guess how that perception may, if at all, have changed?
I think obviously at the start of COVID, obviously everybody sort of just stepped back to work out what the heck was going to emerge. But I think people have recovered from that quite quickly, and I think that BTR as a sector was already really becoming established at the end of last year, and people were seriously starting to turn their attention to it. I mean, casting my mind back to sort of 2013-14, we were absolutely in the trenches trying to get people even to understand the investment opportunity, and then you had the whole valuation challenge and just trying to get people over the line, and we were literally dragging people with us to get the deals done. But I think that post-COVID is actually going to be a much stronger proposition, because I mean, it doesn't take an expert to work out that retail is literally been blown apart. I think offices are actually going to be seriously challenged. Building spec offices, gosh, that's a challenging prospect at the moment, I would think. I'm not an office developer, but build to rent, people will need quality living environments. That's the one thing that will survive this and any further incidents like this going forward. So where you've got a really good, safe, clean, highly managed, and obviously quite often new build now in our sector, because so much new stock coming forward. You're going into a new build apartment, so it's all clean. You've got through that sort of paranoia about who's lived here before, and it's nice and clean. It's managed in the communal areas, and put that together with some communal workspace, which is also going to be managed and clean. You can go downstairs, flip the laptop open in the lounge, and you kind of got the best of all worlds. So I think BTR, particularly with some amenities, is really going to be a solid investment opportunity going forward. I think a lot of investors are realising that post-COVID.
Yeah, couldn't agree more. And Rebecca, similarly, obviously fundraising over recent months. I understand you've sort of deployed quite a bit of that already, and I guess investors continuing to support you going forward.
Absolutely. I mean, I think we've got a great partner. We closed our third fund last April, so May time, which was an initial 500 million of equity, and that's in a 20-year venture that came out of Canada. So echoing what Katie was saying, long dated money. We're focused on the sector for the long term. I mean, I think in terms of when we went into COVID, we were probably slightly and actually surprisingly positive. I think we saw it as one of the only opportunities that we're actually going to get in the sector to get access to land. We're constantly coming up against the traditional house builder for sale model, who outbid us, or other sectors. So there was a very quick initiative, probably within the first 10 days of COVID coming to the forefront, that we changed our strategy quite aggressively. So we're very acquisitive at the moment. We're trying to make the most of the market. Forward funders kind of always been our core focus, but the good thing about our funding that we raised last year was that it now gives us opportunity to buy land directly. So that's really been our focus. I think credit to some of my team. I think they were expecting to have a bit of a free ride when they were working from home, and I think we've worked them much harder than they expected to be. But it's good, and I think our focus has probably shifted more to London in relation to COVID as well. And that opportunity, but we're certainly seeing it. We exchanged on a deal just before COVID, which was a £150 million transaction, and we'll commercially close on that next month. And we've just had approval, or we're just about to go for a final approval on another £200 million transaction. So, the money is still there. They see it as a long-term opportunity for the sector. And it's been interesting as well to see that the debt markets are still very supportive of the sector as well. I think that's heavily relationship driven for obvious reasons, but I think as always, if you underwrite sensibly and you've pitched your product properly, then the money will follow.
And Andrew, similarly from your perspective, seeing product coming through, or?
Yeah, we are seeing product coming through. From our perspective, we very much like Rebecca, we have seen this as an opportunity. There are certain entities who are probably not in the market at the moment, who would otherwise have been in the market. So we are seeing this as a bit of a buying opportunity. Our investment committee has remained operational throughout COVID. We've taken a number of opportunities to the committee, and we've been given approval to make offers on things, which I think is really pleasing. We've also completed on a couple of transactions during COVID, and as Rebecca says, I think my team have been working really hard, albeit remotely, on progressing other deals that we have in our pipeline. We have a very clear strategy about investing in build to rent. It's something we absolutely believe in as a business. It's absolutely the right way for our business to go. And if I think back to sort of when we dipped our first toe in the water, as it were, with our first sort of acquisition of Aberville Apartments down in Barking, to where we are now, we've made huge progress. And I think what COVID has really demonstrated is how resilient the sector is, and it's given us renewed confidence to carry on with that strategy, rolling it out and trying to acquire good opportunities throughout this, so that when we go back to working normally, we will have a better portfolio. So we do see, absolutely, as Rebecca says, it is an opportunity.
Yeah, and I guess that's always been one of my biggest fears, is actually being able to match the capital that sits out there trying to find a home in the UK space. Therefore, it flows to development, as we've touched upon earlier. One of the things I've heard, turning to Katie really, is from a planning perspective, actually, is in many respects actually become a little easier. Has that been your experience on the ground during this period?
No. Does planning ever get easier? I don't know where we're starting from, but it doesn't ever get easier. I think on a positive front, it hasn't got worse. So, and what I mean by that is the planning officers have continued to work. So our biggest fear, and we've got quite a few things going through planning now, as I said, we've bought a few things recently, was that actually the planning officers, given they're renowned for not being the fastest movers, sometimes would make it even more challenging working remotely, or not being able to have the right meetings they need to have, etc. But in actual fact, we've hit the time frames we expected to hit on developments going through planning, which, yes, we'd all like to be quicker, but so what has been pleasing, as I say, is that we've continued to progress through planning at the speed you'd expect to proceed. So I don't think it's got any easier, but it hasn't got any more difficult, and it hasn't necessarily got any slower. Marginally, maybe, right. But I think that's just in everybody's, everybody working from home has a few challenges. So no, that has been pleasing from our respect. Yeah.
Yeah, I think that's sort of what I've been picking up was just that sort of access to planning officers being more readily available.
I mean, that's true. Yeah, I mean, that's true. We're all finding probably that there's less downtime moving between meetings and things like that. So if you want pre-application meetings, things like that, you can get them, which is good.
Anywhere working. And then I guess one of the other challenges sort of picking up a little bit is around supply chain. So how are you seeing that? And obviously picking up in the press this morning as well, just the potential for contractors to struggle getting returns ultimately because of social distancing on sites. What are you finding with your own sites, Katie?
Yeah, so I mean, it's been key during lockdown, as it is always actually, to really work on subcontractor relationships. We are always the main contractor, but obviously we're placing individual packages. So I think it's been really important to work with our subcontractors during lockdown, work with them as to how we could get back onto site when we closed, and obviously working in collaboration. We were actually surprised by the level of engagement and how quickly they wanted to come back to site and how their employees wanted to come back to site. So we set ourselves, quite challenging targets as to how quickly we wanted to try and get back to 100% capacity. And in most cases, we've done that. I think in the most challenging areas in terms of being on site is when you're finishing the building in the internals. Obviously, that's where the social distancing issue becomes more of a bigger deal. I mean, in earlier projects, getting back to site has been relatively straightforward. Subcontractors back at full capacity quite quickly. So I think the real challenge is on developments that are early now. What's going to be the implication, as they get into the internals? But really, I think with all the government incentives that were out there and initiatives and the loans that were quite quickly, although not that clearly set out, and they changed the terms and conditions many times, has helped the sector to get through some of the the cash flow problems. We made sure we continued to pay on time and be fair with our subcontractors. So I'm sure there's going to be some casualties, as there always will be in these situations. They're not cash rich businesses, so there will be some casualties, but in terms of labour and materials, we're pretty much back to where we were before COVID.
Okay, and Tony, you've obviously got quite a lot on site at the moment. What's and with differing contractors, what's been your experience on the ground?
I'm happy to say that we've had a good experience. I mean, it could have been significantly worse, actually.
Yeah.
We've got some great contractors at the moment. Simon, that we spend a lot of time with. We've got a very strong project delivery team in-house. So we get very close to our contractors. We know how they work. We know the subcontractors. We stay close to them all through this difficult time. But between, we've got CISC on Birmingham, we've got Beijing on Liverpool, we've got Cannock on Leeds, we've got Robertson's in Edinburgh. In fact, the only real challenge, and we had sympathy for the Robertson's team, who are an excellent proactive team, but Nicola decided that building sites should be closed down in Scotland.
This is Nicola Sturgeon, yeah, Tony? Nicola
Sturgeon, yeah. I'm sure she had her reasons, and that created a massive frustration for Robertson's, who had really just got into the swing of our Springside development for 500 units in Edinburgh. So they were slowed down. That was really tough for them. But obviously we work together, support them, and now they're fully back on. So all of our projects now are going at full tilt. And actually, I think whereas on a couple of sites we lost a few weeks, they've made that back up. So actually we're okay, and it could have been a lot worse, but it's fine.
Yeah. So it's interesting. No geographical challenges apart from in Scotland. In terms of that sort of aspiration to grow the portfolio, Rebecca, you sort of highlighted London and the South East has become more of a target, but generally looking still for a spread throughout the country.
Yeah, absolutely. I mean, when we closed the partnership, the weighting had kind of shifted 70% London, 30% regions. I think in light of COVID and just the opportunity we're seeing, we're probably more like 90% London at the moment rather than the regions. And I think that there's a number of reasons, behind that. I think some of the regional cities as well, have kind of inflated their expectations on land over the last maybe 18 months. And they always tend to lag a little bit behind the kind of London market. So if you think, you know, the London market was starting to cool down. They were only just starting to, you know, to heat back up again after the 3 years. So there's always that slight lag. So it doesn't, you know, we're very happy with our assets in the regions at the moment. We are still looking at regional assets in some of those tier 1 and even tier 2 regional cities, but we're being a lot more selective. And as I said, I think it's fair to say that we're really focusing the majority of our attention at the moment on London.
Yeah, and Andrew, obviously diverse portfolio, and actually I think in many respects often look to Grainger with that sort of management background and scale to perhaps even beyond the tier 1 and tier 2 locations. What's the sort of current sentiment on the acquisition trail at the moment?
Yeah, broadly as we were before COVID reared its head, actually. You know, we have a very clear strategy of where we want to invest. We've done a huge amount of work internally looking at what we think the markets are, where we want to be. And we continue to see opportunities coming to us across a range of those locations. Clearly, London is a standout location because of the size of the market available. And so I think we will continue to invest significant sums in London going forward, as we are doing, you know, through our TfL partnership, for example, which we've made fantastic progress on. We've now got planning applications running on 3 of those sites, so that's really pleasing. But that's not to say that if the right regional opportunity comes in, we won't look at it. Of course we will. There are certain places where we think we probably think for the time being we've got enough, and we're watching how the market how the market grows and how the supply demand reacts. But broadly speaking, we're looking for opportunities across the country.
I mean, I think the elasticity in the regions is obviously going to be something that we're keeping an eye on at the moment with regards to rents. And that kind of goes back to my point about landowners and developers' expectations on where pricing is. There's often that point where build to rent works to a point because the rents, you know, can only stretch so far, and then you flip into the sales market, and then in a downturn, it kind of, you know, that counter-cyclical nature comes through. Whereas, you know, in London, you've got a much more diverse range and much more elasticity on the rents, you know, from the affordable, you know, key workers, one of our key focuses at the moment, you know, and then up to the kind of the more premium offer as well.
Right. I'm not going to bite on Tony's reference to valuation challenges in the sector, but just quickly turn to Katie in terms of sort of focus from a Telford perspective and geographical aspirations. I mean, historically always associated Telford with London and the South East specifically. Any sort of ideas of going further afield?
Yeah, I think we've always focused on London. 2 reasons mainly. I think we think fundamentally the market is buoyant and always will be, and there'll always be the demand there. But secondly, prior to acquisition, we would have had a limited capital stack. You know, with limited capital resources, there was more than enough opportunities to keep us busy in London. And obviously, London's a big area with lots of, you know, diverse locations and variations. But now we are focusing solely on build to rent. We'd started to think about, you know, could we spread out a little bit to the commuter belt, and with the capital behind us from CBRE and TCC, it's not an endless pot. It never is an endless pot, but it sort of is. If it works and it gets through the investment committee, then we've got the capital to buy it. So what we believe is one of our key strengths is still being the main contractor on the development and retaining that role to keep control of the project. So our first stage of expansion will be commuter belts and towns where we can effectively still run our subcontractors and still be the main contractor. Then the second stage potentially could be further afield, but that then is a whole different strategy in terms of our supply chain and whether we retain the main contractor role, etc. So now we're actively looking in the commuter belt around London, and if the opportunity works, then we'll take it.
And Tony, obviously Moda historically has been very regionally focused. I think having had conversations with you in the past, the challenges as Rebecca's alluded to in terms of competing with the build for sale operators. Is there sort of aspiration to sort of, shall I say, balance the portfolio in terms of more stock south?
Yeah.
South of Watford?
Yeah, well, as you know, Simon, we've long been looking at London. There is no denying that, especially in a crisis like this, London becomes, you know, the location of choice. I mean, that's an absolute fact. I think was proved after the financial crisis, been proved in COVID. So London is certainly on our target range, and we are actively talking about a few things in London at the moment. We're building our team up, as you know, in London. Traditionally, we started out in the regions. You know, we're based here in Harrogate, and we started out Manchester, Leeds, Liverpool. Our theory is, I think if we stick to the sort of top 12 cities in the UK, I think at the moment it's very challenging for the secondary cities at this stage in the BTR process, because it's still a relatively new investment class. But so we really need to focus in the top regional capitals, if you like. That way, as Rebecca said, the rents stand up to the appraisal. It means you can just about get the schemes over the line. But the upside is, of course, you get more growth, and you can be a really big fish in a slightly smaller pool, and that drives a lot of quality tenants to your building. And I think that's what's happened in Angel Gardens, and I think that's what's going to happen in Birmingham at our Mercy and the Tower, for instance. So the regions are definitely a good pool to fish in if you've got the right kind of product in the right location. At this juncture, I definitely wouldn't be looking at secondary cities, I'm afraid to say, although it would be great one day if you could go into those secondary cities with smaller schemes, maybe low rise, and I'm sure that will come in due course. But for the time being, I think London and the regional capitals is where it's at.
Yeah, it's interesting you're picking up on the sort of low rise, taking low rise to the lowest rise, I guess, is some of the talk that's been referencing around single family housing as our stateside colleagues talk. I mean, Andrew, I think it's something that Grainger have looked at. Is that an area that you're going to spend more time looking at?
Yeah, it's something we've looked at, and it's something that we will continue to look at. We do have a couple of what I would describe as suburban schemes. So we have a scheme down at Beerwood in Hampshire, and also at Aldershot. I think for us going forward, I slightly worry that this sort of speculation that everybody's going to want to work from home, everyone's going to want a garden, that we're going to depopulate our cities is being slightly overdone. I think sort of turning the clock back on 200 years of urbanisation for what has been 3 months of lockdown, I think is probably a little bit too much to sort of think about. So I think we are looking at more suburban opportunities, but we're very focused on where we want those to be. And generally, in my mind, we want them to be in areas where we might find it more difficult to access sort of city centre build to rent, because house prices are too high to make the model work for us. So in those markets, I'll give the example of Cambridge, for instance, where there's very limited land supply in Cambridge because of the ownership structure of the land, with the Cambridge colleges owning lots of it. We may well start thinking about more suburban product on the outskirts of the city, which would be low-rise, actually. And I quite like the low-rise opportunity. I think there's potentially a different gross to net analysis that you'd use. Obviously, I think the design of it's really important to minimise those common areas to help drive down that gross to net. But I think if you can provide a range of apartments together with some houses for those families who maybe are struggling to get onto the housing ladder because of the high frictional costs of buying, then I think that is something that could be interesting. But what I don't think we're going to do is just sort of start going after sort of house builder type sites all over the country to provide a more suburban housing model. That's not where we want to be. It's not really what we think will work. Our focus will remain on sort of city centre build to rent together with suburban housing in specific areas.
Right.
I think in sector two, we really need to get an understanding of the returns, because the yields are already quite tight in the sector and the apartment market, and I think you can't just simply apply those dynamics to a single family housing. So I think as a sector, we've kind of got to get our heads around that. But I think there's no doubt, I've been hearing a lot of chatter in the market around single family housing, all positive, and actually investor appetite seems to be, there is equity available for those schemes, but I think what Andrew said, it's very location specific, and it's not just going to happen on any estate in the middle of nowhere to kind of prop up the house building market.
And Katie's area that Telford, sorry Tony, Katie, is that an area that?
Go ahead, Simon.
Is that an area, Katie, that Telford have been looking at all?
We haven't. Don't debate that it might work, and it is working. I know M&G have got investments in that sort of thing, but we haven't, because more just from the where we've been delivering so far in London, it doesn't really work. I think when we're moving outside of London, we'll focus on what we are typically good at, which is what we've been doing for the last 20 years. Not to say we won't in the future, but building houses is actually quite different to building a 20-story tower, for example. So I think you've got to be careful that we don't just say, well, we can build that. We probably can, but it's not as simple as just moving that quickly. So I think for now we'll focus on what we've been doing historically, which is more like the high rise.
More of the same.
Yeah.
Tony, sorry.
Yeah, my point very, very nicely adds on to Kate's point, because you've really got to think about your operational costs, post completion, and your net operating income. So when you start moving into single family housing and very low rise, obviously bigger buildings, bigger land take, etc., your operating costs in terms of your maintenance, your planned maintenance, your grounds maintenance, roof to wall to floor ratios, all of them things change quite significantly. And I don't think anybody would be able to put their hand up today and say, we can operate a build-to-rent housing estate, for instance, at an absolutely clear cost base, because I think that's where it could kind of be very challenging, and it could unravel quite a bit, because you've got just so much more building fabric per square foot to maintain. So that's one of the things that's put us off.
Interesting. I see we've got quite a number of questions, so from the audience. So let me see if we can deal with some of these. Had one here in terms of what impact do you think COVID will have in the longer term on rental values due to consumer affordability concerns in a recession? I guess Andrew, been in the sector and seen the data and have been through these sorts of cycles before. Perhaps talking post GFC most specifically, how did you see that sort of pan out?
I think if you compare rents and rental growth to house price inflation, rents are a lot less volatile. They are much more closely aligned to wage growth, whereas house prices move for a whole variety of reasons. So I think what we don't know is we clearly don't know the impact on the economy once the furlough scheme is withdrawn. There clearly is going to be some pain in the economy, and it depends on the scale of that pain. I think will depend on what happens to rent. But I think I've been looking with great interest at some of the forecasts coming out from the main agents, and JLL being one of them. And broadly, what I'm seeing is in the market is most commentators sort of saying potentially sort of a -2% peak to trough on rents. But then again, I think it's going to be very dependent on where the scheme is, the quality of the product, and also the impact of the furlough scheme being withdrawn. So I sort of think it's a little bit too early to be sort of thinking where rents will be going. But I do think that this crisis is very different to any other crisis that we've been through. Usually we go through an economic crisis. It's the result of asset prices getting to a point where they are too high, or interest rates getting to a point where they are too high, and entities and individuals are unable to service that debt. This is very different. This is a crisis born about by a health issue, and the government essentially shutting down the economy. So I do sort of personally think that once the furlough scheme comes to an end, there is going to be that pain. But then I do think the economy will bounce back quite quickly, because I think the government are super keen to support it. So, and that will obviously limit the impact on any downward pressure on rents, in my view.
I think it depends on, I mean, a lot of our customers, where we've done surveys, even if they have been furloughed, they didn't want to tell us because they were worried that we were going to kind of evict them, or something like that. They were more interested in stability of retaining their homes, paying their rent, and then if there was going to be a problem, having a chat to us. I mean, to be honest with you, a lot of the people who've come to us to talk about rent reductions or deferrals have been more opportunistic rather than people who are actually in pain, which isn't a nice thing to say, but it's a fact about what we're seeing. And I think, as Andrew says, I think the effect of furlough is going to have an impact. But I also think the mortgage markets and availability to capital for. I was going to be buying my first house this year. I've just gone back to the mortgage market, and my deposit has gone up to 17%. So it then changes, your availability. So I'll probably be renting for a little bit longer, and I'm sure there's going to be other people, in the same pool as that. So I think, you know, longer term trends, you tend to see the rental market be more resilient. People want their homes to be secure for longer. And so I think that's why build to rent at the moment is still going to be, you know, best placed, certainly, you know, in the long term.
Couldn't agree more. I think flicking through the questions, there's a lot of what's COVID meaning on the other side in terms of design. I guess looking at delivery of new products, obviously Tony been very focused on the amenity side. Do you see you learning lessons already in terms of what your consumers in Angel are really buying into? And there's often been a debate around whether the UK really needs that level of service provision within purpose-built rental stock. What's the sort of feedback on the ground?
Well, good question, and we have had some great feedback on the ground. I mean, very interestingly, since COVID, we saw a 550% increase uptake in our resident events. You know, before COVID, people were not really looking at that. They were leading their busy lives, commuting, zooming off to work every morning. But during COVID, everybody looked more focused into our app, as I said at the start, and they got more involved. And I think now they've experienced that, they're really going to start using the buildings in the best possible way. And I think I'm not a supporter of over amenitizing buildings. I think things like swimming pools and wet rooms are really challenging on the op costs, back to the op costs thing. But I think a decent amount of a really good quality space where you can get out of your apartment, go downstairs for a couple of hours, or upstairs onto a roof terrace like at Angel Gardens, for instance, on a great day, and do a bit of work up there, do a bit of relaxation, work with our health and partners hero in the gyms. I think that is going to play enormously well post-COVID, because you've got all of your amenities really close by in the same building. You don't have to go on public transport. You don't have to put yourself at any more risk, yet you get all of the benefits. So I've got to say, I think BTR has had effectively quite a good outcome from the COVID situation. I think it will really start to shine in terms of how it's going to work for our residents.
I think flexibility is going to be key going forward. I mean, I think Andrew mentioned to me something before, and I've heard it in the market, that people are looking to introduce a covenant for build to rent and like a specific use space, which I think is the worst thing possible, because, you know, what we're learning from the property sector is that people are living differently. So why pigeonhole specific, spaces to be retail or to be build to rent versus private to sell? I think same with the amenity. I think having flexibility for people to use those spaces as they wish, that can be working from home. And I think size of the apartments is going to still become key, because I think, in the downturn, why we retained a lot of our tenants, because we've always tried to keep, good, decent size apartments or slightly bigger than the market, which has definitely helped. So I think there'll be more consideration around apartment layouts and the flexibility of the amenity going forward. There's a big chatter at the moment about people wanting outdoor space, which, is obvious. I think that's like asking people if, a barber, if you need a haircut. I think we've just got to be careful as a sector not to be too knee-jerk reaction and start designing lots of space in because of, a 3-month or 4-month event that kind of, is going to change us long term. But I think there's no doubt people are going to be changing their habits going forward. We've just got to be considerate of those and careful over the long term, I think.
Have you found on flexibility, have you found people wanting to move within buildings, either up to a bigger unit for an office or to a smaller unit for cost reasons?
We've had people, especially people who are maybe working with key workers. So, if they're sharing a flat with somebody who works with the NHS, we've been able to accommodate them within our buildings to kind of move into a 1-bed for the time being and things. And yeah, probably people more wanting to stay where they are, but see if there's other options within the building. So it kind of goes back to the thought that we had before around, staying, building that community. People will want to stay. So yeah, it'd be interesting to see if that continues.
Yeah. And has there been any shift since, sorry, Simon, I'm taking over.
No, that's right. That's perfect.
Has there been any shift in demands for, bedrooms, so 1-bed, 2-bed, 3-beds versus pre-COVID leasing, or is it too soon to see that? No.
Yeah. And we've had a question. Sorry, Tony.
That actually, Katie, that this is not necessarily COVID related, but we're definitely looking at putting more 3-beds in our units going forward. We had, when we first embarked on our schemes and our planning applications, we were really we were being pushed by planners to put 3 beds in, and we were not really going there. But actually, you know, when we've actually built out and we've got these buildings finished, 3 beds are doing very, very well. And every time we bring a 3 bed to market, it goes. And we've actually got families with little kids living in Angel Gardens, which is absolutely brilliant. And I think that is really the start of something that we want to spend more time on. And we will definitely look at more 3 bed units now.
I think that's something we're hearing commonly across the sector, isn't it? And I think it goes back to Rebecca's point around flexibility and perhaps a demographic that you've touched on already, Tony, in terms of sort of co-living. Okay, not in the way that we talk about it generally, but there's a question around sort of as a group, would you be looking at the later living area? And certainly something I'm hearing is actually this sort of initial perception of build-to-rent product being targeted for the sort of 18-35-year-old age group. Certainly what I'm hearing is there's a much wider pool of occupiers. Andrew, perhaps if you could pick that one up in the first instance.
Yeah, that's fine. I think from a Grainger perspective, we've been very clear in terms of what our strategy is, and that's to provide very good quality at a mid-market price available to everybody. So as it stands at the minute, we have no aspirations to go into the later living sector, but that's not to say that we wouldn't encourage people from that sector living in our buildings. I think the example that Tony gave of people, of families living in Angel Gardens is exactly what we're seeing across our portfolio. And we think if you're trying to create a community, actually what you want in that community is people from a variety of different age groups. So that's our focus. And also it's partly driven by the fact we think the market that we're aiming to cater for is so wide. That mid-market that we are ideally targeting is such a deep market that as it stands at the minute, we don't feel that we need to start adjusting our strategy, because we've still got so much more we believe we can deliver that specifically caters to that market, which our product is aligned to.
Yeah, and I think it really flows to that sort of resilience of the sector. Obviously, those that are in it already, but that deepening level of demand. And I know the group's obviously called out. It's no longer a tenure of necessity; it's a tenure of choice. And I think that's certainly coming through loud and clear. Just before I put you all on the spot, I'll turn to Katie in terms of expectations around expectation on build prices going forward. But what I'd like you all to think about is in one particular area. Obviously, during these periods of massive change, we often see quite substantial changes in legislation, or so just what you would like to see in order to make life easier to acquire more stock within the sector or develop your portfolios further. But just while the panel are having a chance to have a bit of a think about that, Katie, in terms of sort of one of the other questions that came through on the floor was really just expectation on build prices. Obviously, it's the major contributor generally in terms of developing this sort of stock. So where's your sense around where construction costs are likely to go over the next 12, 24 months?
Yeah, okay. So if you're asking my MD, he would say, "Oh, you've got to be careful here." But now I think we've already seen, and even before COVID, we were already seeing, particularly in London, very much an easing in terms of pricing. There was clearly availability in the markets with subcontractors, and so pricing was getting more competitive, obviously in our favour, even before COVID. I think it's quite difficult to predict now without having, how many subcontractors are actually going to survive. It's looking pretty positive. Is there going to be an issue in terms of material availability? That's looking okay. There was a small blip, but that's looking okay. Is there going to be as much building work? Probably not from a for sale point of view, which is the trend we were seeing before, which is good. So we are not really that nervous about build costs. We're not expecting build costs to necessarily fall too much either, because you've still got material prices, and particularly in London, you've still got the labour costs, which we don't expect to change too much. So I think we'd be saying in our forecast, we're not expecting significant increases, but equally we're not expecting significant decreases either.
On the status quo. So turning to my question then, Tony, to make life easier for you, what would you like to see change in the market?
Gosh, I guess that one thing I'd like to see is the recognition by planners that build to rent, well designed and delivered build to rent, fills a very important gap between affordable housing and private for sale. I mean, as Rebecca said, private for sale, extraordinarily difficult to get on that housing ladder now, you know, cost of, size of deposits in particular. So I think that we don't have a super difficult time with affordable housing, but if that conversation was easier, and if authorities recognised that we're putting an enormous amount of investment into a city with, you know, the public-private realm around our buildings, the public spaces that we're building at our cost, and I think that should be recognised that BTR is a next step up from affordable and should be recognised as such.
Thank you. Rebecca, from your perspective?
Again, I mean, I think echoing what Tony says, I think that the understanding and the recognition of build to rent needs to go beyond planners, but, you know, through central government and key government bodies. And I'm hoping that, you know, this downturn and actually, you know, the last 18 months for the sector will demonstrate, you know, the need for good quality rental product, and that people can kind of see the benefits of build to rent through all of the things that we've talked about today. I mean, I think, you know, build to rent's actually really well placed to kind of sit behind some of those government initiatives like modern methods of construction. You know, there's been a lot of chatter about it the last couple of years with no real kind of clear roadmap, but build to rent is a sector that ultimately is well placed to kind of adopt that. You know, speed of delivery is key for us, where we're all focused on getting homes and income delivered as quickly as possible. But I think just coming out with a blunt instrument around modern methods of construction, I think as a sector, it'd be good to see some kind of incentives to use, you know, modern methods. And I'm not talking about big financial incentives. I'm just talking about, you know, an adjustment of potentially SIL or affordable housing in its traditional sense. But, you know, I think build to rent's very well placed to provide accommodation for key workers. There are gaps in the market that don't tend to benefit from affordable housing in its traditional sense. They don't normally meet those requirements for social or affordable housing. And so I think those sorts of things should be recognised. I mean, the list is long. We've all talked about it, VAT and having build to rent treated like a commercial property, how we deal with council tax in let up. I could go on and on, but I'll let the others pick up on some of those points.
Trying to steal Andrew's thunder. Andrew?
Yeah, I was going to pick two of the examples that Rebecca's just mentioned, because I think there needs to be a greater understanding about the operational difficulties around build to rent. And actually, the numbers are tight. So when we look at our gross to net analysis, it is tight. So, you know, for me, looking at it from an operational perspective, my biggest bugbear is landlord licensing. I think in certain local authorities where we have to fill out an individual licensing form for every unit is completely ridiculous. And then we have to pay a fee on each one of the forms. So if it's £100 and it's 100 units, you know, it's a very considerable amount of money that goes straight to the bottom line. And it impacts the operational cost, which ultimately then impacts viability. And then the other 2 points that Rebecca made, VAT on repairs and maintenance, clearly, it has an impact on gross to net, has an impact on running cost, and ultimately therefore goes to viability. And then the other point is around council tax on empty homes. You know, everybody wants these homes delivered quickly. And if I look at our big development up at Manchester at Clippers Quay, 614 homes delivered in 18 months. So from delivery of the first unit to the last unit, it was 18 months. If that had been brought forward by a private for sale developer, you could argue it would have taken them 5, maybe 6 years to do that. But then because we've delivered them all, you know, we have to pay council tax on those empty units. Again, impacts operational cost and therefore impacts viability. So those would be my asks.
Thank you. And Katie?
I think covered off pretty well by the rest of the panel, but from our point of view, the early stages in terms of the planning, because obviously we're not into the leasing and management sector, so it's more about the planning and the planning authorities understanding and not insisting on late stage reviews and all that sort of stuff is really important to us. Some are better than others. It'll take a long time, I'm sure. Just
understanding and familiarity. Well, I'm very conscious of our time allocated today. I think we've managed to cover hopefully a lot of the questions, and thank you for the audience for those. That's been great, and just like to thank you all today. Lee.
Right, thanks Simon, and thank you to you all. What a stimulating, absolutely fascinating discussion, and it was really positive. It's so good to hear that Build to Rent has performed so well, I think, you know, through COVID, you know, through lockdown, and definitely compared to, as you said, sort of retail and commercial, it's done really well, and it does appear that it really is now, you know, a solid long-term investment opportunity, which is really, really good to see. And it's interesting, I guess London is still this standalone location, the jewel in the crown, but nice to see that some regional, I guess the capital cities, as you said, were the ones that are really attracting the investment going forward. So fascinating stuff, lots to build upon, and thank you all indeed. Thank you for your time. Thank you to our audience today as well. And just to mention, our next event is actually next Tuesday, the 30th of June. On repurposing the West End. We've got a superb lineup. We've got Jace Terrell, who will be speaking from the new West End company. We've got Brian Bickle of Shaftesbury. We've also got the leader of Westminster City Council. It'll be chaired by Susan Freeman. So it's going to be a superb event. So do go onto our website, moversandshakers.uk.com. Do register for that. Following week, we're going to have an interview with Andy Street, who is obviously Mayor the West Midlands, so lots and lots to look forward to. So please do view our events as well on YouTube. Do have a look. We've got 14 events so far on there from this period for you to look at, and do subscribe. Thank you again. Enjoy your day. Keep safe from our family to yours.